We focus on a different subsector of the asset class, which is more construction related. So those are generally under 10 acres is the sweet spot. And most of these sites are single tenant. So when you get over 10 acres, it starts to become a pretty big rent number for that single tenant to pay. So we just there is a little bit of a sweet spot for demand, and so we try to stay in that side of it. But I would say if you were just a private investor and you were going out looking to buy one of these, I'd probably focus on 1 to 3 acre sites, depending what market you're in, and you can get a deal in like the $2 to $10 million range.
Welcome to CRE Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Blake Rodgers. Blake Rodgers is the co-founder at Steel Peak Properties. Steel Peak is a Southern California-based real estate investment firm focused on acquiring and improving industrial outdoor storage assets throughout the Western U.S. And in just a minute, we're going to speak with Blake Rodgers about outdoor storage properties. But first, a quick reminder, if you like our show, CRE Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Blake Rodgers. Welcome to CRE Radio.
Thanks for having me.
Well, I'm glad you're here, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, so I am one of the co-founders of Steel Peak Properties. We are an industrial outdoor storage focused investment group, and we're based in Southern California, actually San Diego. We started the firm, myself and my partner, in January of 2024. Since then, we've bought, hopefully by the time this airs, our 10th deal across the Western U.S. And we buy industrial outdoor storage properties. So what that is, I can definitely get into that, but it's a smaller subsector of the greater industrial real estate kind of sector. So it's a niche asset class, smaller deal sizes, with an emphasis on the yard space, on the outdoor storage space.
Got it. Well, that's kind of where I was hoping to start, is just a definition of what outdoor storage properties, if you can define them.
Yeah.
Is it strictly, do you define it by yard, or is there any structure? Are there any structures on the property?
Yeah. So what we do is a little bit different. Everything that we buy does have a structure. That's one of our kind of focuses. But so everything that we're buying, technically, there's a couple different names for them. Either industrial service facilities is a common name. The acronym now that everyone's using is IOS, which is industrial outdoor storage. So the outdoor storage component, that's what makes these properties special. There's more land and more yard space than typical on an industrial building. So the way that you define it is the building has less than 25% coverage on the total site. So usually standard industrial buildings are anywhere from like 35 to 50%. A lot of the older buildings are built out to kind of max out that site coverage. So if you take, that 50% coverage and you net out, let's say 25%. So you're at our top, the biggest building we would buy is like 25% coverage on a site. You've still got maybe, you know, 25% more excess yard space than you would on a typical, if you're looking at, you know, let's just call it like a 5 acre piece. Maybe you've got an additional excess acre of land on that piece.
Got it. And for the property, you kind of defined what the coverage ratio is, but I'm kind of curious. What's the typical use? Is it
Yeah.
just parking? Is it lay down storage? What's the
Yeah, so there's a bunch of different uses, but there's really two categories. It falls into truck parking, logistics is one category, and then you've got construction related uses. So contractors, building material storage, equipment storage. We own an equipment rental facility, those types of properties.
Oh, that makes sense. And as far as location for these types of properties, is it important that they be located like near an interstate or a construction site, or how, what are some, you know, what I guess I'm trying to figure out if there's a specific type of place these are located or where you typically find them.
So, excuse me. So if you're in the industrial real estate business and you're just looking at a standard industrial submarket in like a greater, like let's say Portland, for example, where you're from, Portland's got their specific areas where a lot of the industrial product is. We just call those infill industrial locations where there's a bunch of industrial built next to each other. And you'll see these iOS properties. They're there's some of them are in like there's more of them in certain areas than others, but they're dispersed throughout just the standard industrial markets. There might be five regular buildings and there might be one iOS site. There's less of them, so they're harder to come by. That's why we like them. And because a lot of them get built out, and developers want to put a bigger building on them. So there's not as many of them, but they're just you can find them when you're driving down the highway. A lot of them are along freeways. Just the nature of some of the uses, like equipment rental, they kind of want to be seen while you're on the freeway. So those guys have big signs and they have their equipment up in the air so you can see it. So some of those uses that have more of like a sales and leasing component to them are more so along highways. Some of them that are even heavier uses, like some of the uses are, let's say, recycling or waste management. Those guys want to be tucked back and, they don't want to be disturbed. They don't want the city coming around too much. Some of these are like very heavy industrial uses, but they're all spread out throughout your normal, typical industrial pockets. We actually don't want to buy sites that are too far out on the outskirts of town. We try to stay in the big metro city areas.
Got it. And some of the other characteristics, are they typically fenced?
Yep. Yep. So think like a small building, let's say anywhere from like 3,000 to 30,000 square feet on 2 to 10 acres, fenced, secured, either gravel or paved. Sometimes it's mainly just paved around the building, and then the rest of the yard is gravel. And then there's lighting sometimes in the yard, sometimes there's not. And then the building has some office space and then some shop slash warehouse space. A lot of the time, the warehouse space is used to maintain the trucks, the vehicles, the equipment versus storing stuff indoors. So it's a little bit different than your normal distribution or just warehouse storage space. Most of the shop space is used to actually do maintenance in these buildings.
Got it. So I'm assuming all level ground is a priority. You
Uh,
mentioned, or I'm sorry, go ahead.
yeah, yeah. Most of these sites are just level, kind of flat, standard sites.
And you talked about size, I mean, up to 10 acres. Is there a a typical or is there a sweet spot kind of thing that you find on these as far as just a you know opportunity or is it?
Yeah. Yeah. It depends what your strategy is and what market you're looking in. Some markets that are more port driven, they might have a bigger truck parking demand in that market because they're working with the ports and they're taking containers off ships and then they're shipping those out across the US and they're landing at different either like truck terminals and then they're switching and going to a different warehouse and then they end up at the end user's warehouse and then they go out to the consumer from there. So the trucking side of the business for iOS, like a lot of those sites, those can easily be 10 acres plus. Like you can go buy a 20, 30 acre site. You might have a couple different tenants on that site, or it might be one really large tenant, but those are usually in bigger kind of port markets. We focus on a different subsector of the asset class, which is more construction related. So those are generally under 10 acres is the sweet spot. And most of these sites are single tenant. So when you get over 10 acres, it starts to become a pretty big rent number for that single tenant to pay. So we just there is a little bit of a sweet spot for demand. And so we try to stay in that side of it. But I would say if you were just a private investor and you were going out looking to buy one of these, I'd probably focus on 1 to 3 acre sites, depending what market you're in, and you can get a deal in like the $2 to $10 million range.
I was going to ask you about pricing on this. Typically it seems like most people I talk with are, there's some sort of a structure and the revenues, based on whatever the rent they can generate. For this type of product, uh, is there an equation based on square footage to market rent, or is it just basically if you're the only place in town or nearby, you can you can charge a lot more than if there's a lot of places?
I wish it was that easy all the
Yeah,
time. It definitely is in some of these markets. If you find a property that there's just no other there's nothing like it that's available or that has been available for a couple of years, and then you can kind of set the price, but within reason. So the formula is really just you put a price per square foot on the building. So you just take a normal building lease rate and you slap that on the building, and then any yard that's excess, that's considered excess yard, you just go slap a land rate on that. And that's usually priced per acre per month, is kind of how most markets do it. So we use an actual land rate per square foot. But let's say the building might be $1 a foot. It's a 15,000 foot building. So that's 15 grand a month. And then your excess yard, let's say you have an acre of excess yard at 5 grand per month. So you add that 5 grand to the 15. So now your rent's 20 grand a month. If it was just a normal industrial building, you'd only be getting 15 grand a month because there's no excess yard. So we're just charging on the excess yard. And the reason that we can charge on that is because it's really valuable for these tenants. It's hard to find, and the zoning has to allow outdoor storage uses by right for that zoning. So it has to be a little bit heavier than like your typical zoning that you'd find in like a business park, for example.
so that zoning, um, is it difficult to get?
So if it's not already allowed in the zoning code, then it's pretty difficult to get. You have to go through like a conditional use permit process, and so you have to go to the city. It's most of the time it's discretionary too. They can tell you yes or no, depending on what market you're in. Sometimes it's easier if you're in, a municipality that's pretty flexible and they're not too conservative. It might take a few months, but in California, for example, it can take like a year to get a CUP, and they can tell you no. And they can say, hey, you got to go do X, Y, and Z now to your property to get it up to these standards in order to get that permit. And then that cost of the capex that you'd have to do if you didn't put that in your underwriting, that could be, a couple $1 million that you weren't ready for, and it just blows up the whole deal. So the zoning is a key to finding these. So if you can find the existing assets that have the zoning and the tenant can just move in immediately and they know that their use works for it, that's where a lot of the value is.
Well, that makes sense. If it's already allowed, you're, now it's a matter of just finding a tenant that fits the profile of what the property will allow.
Hmm.
But I'm curious on the properties where you might, have to seek a variance or whatever. Um, Given that you're talking a minimal structure, uh, and it'd be more of a use. I'm kind of curious, what would you see that they would, municipality could require in order for the use of storage?
So some of the common things that we see are, let's say the property as it currently exists has a small building with a gravel yard and it's fenced and secured. They might say, hey, we actually want a CMU wall, so like a brick, like really nice wall, and it needs to be 6 feet high, and it needs to, you know, or maybe it needs to be even higher. Let's say it needs to cover. We don't want to be able to see any of your trucks, so we want it to be like 10 feet high, so people don't have to see trucks from the street. And then they'll say, hey, we're going to require you to have setbacks for landscaping now too. And we want you to do all this landscaping so it looks nice from the street. We want you to have lighting and we want you to pave the site. So things like that, that'll just kind of, blow up your costs.
Got it. Got it. So these properties, I mean, it doesn't sound like, um, as far as capital improvements, once you have an established, an allowable use, and you have a tenant, um, and there's demand, what I'm just trying to think of what would be your capital expenses other than taxes and insurance and maybe some utilities, unless I'm assuming you pass those on to the tenant, especially the
Hmm.
single tenant.
Yeah, these are all single tenant triple net lease properties, so we pass all that on to the tenant. So the ongoing management is very minimal, as well as the upfront capital improvements. Those are also minimal. It's just site work, kind of stuff that I mentioned. If you want to, fix up the asphalt or the gravel, the fencing, lighting, and then it's the building exterior, and then it's the interior of the building, but it's a small building. So standard kind of office tenant improvement stuff, and uh, and then making sure that the property has um, the correct stormwater retention, things like that.
Right. Now I could see the stormwater drainage, and especially if you got a bunch of trucks and not necessarily a pollution issue, but I could see that being a concern just based on all the, fuel and just the vehicles on there and stuff. But um, hmm, I'm curious, are you guys, do you operate as a fund? Are you, um, what's your strategy for your hold time on these?
Yeah, so we're value add investors, and so we're not holding these more than 5 years is kind of our game plan. So we're trying to get in and buy sites that have, less than a couple years of remaining lease term in there so that we can go in, do our improvements, increase the rents, bring a new tenant in there, ideally like a large national company to lease it from us. And then we'll either sell it or wrap it into a portfolio and refinance it as a portfolio. And so the way that we capitalize these, our first couple of deals as we got started was just friends and family syndication. Um, we still do raise some money from friends and family, but most of our investors now are institutional private equity companies or big family offices. And we're currently working on just, having one investor going forward is likely how it's going to work because we have to do so many deals per year to get to do the volume that we'd like to do as a company in order to scale. And these deals are small. So it's easier to have, one source of capital to go out and do this. Ideally, one day maybe we have our own fund, but right now we're doing joint ventures to get there. So
And so your hold time, what's a realistic hold time or a target hold time?
yeah, I'd say 3 years is kind of what we've been using on a lot of the deals, 3 to 5 year hold. And but we have sold a couple that have been a lot quicker. We sold one in 3 months, and then we just sold one a couple days ago that was an 18-month hold.
Okay. And as far as the uh, profile of the sellers, are you typically finding these owned by individuals? Or are they other commercial, um, portfolio owners, or who are you buying from?
Yeah, most of the space is still mom and pop owners. So it's a lot of either, private families that own these, private family trusts, just private investors. A lot of the product is owned by owner occupiers that have had their business in there for 30 plus years. And so a lot of the groups that we buy from, they're either winding down their business, they're retiring, or they're just kind of they're cashing out their investments, and maybe they didn't want to pass it down to their kids, and their kids don't want to manage the real estate. They didn't want to put a bunch of money into it. To maybe their lease was coming up with their tenant. So we come in and we say, hey, we can do all that. We'll put the work in. We'll do the leasing process, take it off your hands, and so it's a lot of mom and pop owners that we're dealing with.
Got it. And financing, you've got a single source that's allowing you to kind of go fast. Is that kind of what I'm hearing?
Yeah, we have a couple lenders that we use on most of our deals that allow us to go quickly. And we'll buy it with, basically bridge debt going in or all cash, and we won't even put debt on it. And then we'll refinance it at a later date.
So, what does the financing look like? I mean, when you don't have, I mean, you've got structures on there, but I mean, is it basically like a typical commercial deal where they look at your, you know, uh, the revenue and your net operating income, and they want a, 125 debt service cover ratio, or what are you looking at?
Yeah, so if the property's leased and stabilized, then we can go out and get normal bank debt, which is just normal commercial financing on the property, and we'll try to get a 5 year fixed rate on that. And then same has 120, 125 plus debt coverage ratio on those. And then but our if we're going into a deal and we're not going to buy it all cash and we want to put debt on it, that's going to be your higher octane, 1 or 2 year loan. It's going to be a lot higher interest rate. It's going to, there's going to be some cost as well going in and going out of the loan. And you're working with like debt funds and bridge lenders in that case.
Got it. And as far as uh, we talked about, or you mentioned the triple net tenants take care of the property taxes. Is that
Yeah.
that's
Yeah. We
one?
pass
Okay.
through property
Okay.
management, property taxes, and insurance as well to our tenants.
Got it. And depreciation, is that basically, I'm assuming that's limited to the structure on the property.
Yeah, there's not as much as if you were buying like multifamily or self-storage or something like that. So, um, yeah, that's an interesting difference with what we're buying. You don't get as
Right.
much.
No, but if you can, at the end of the day, if you can find something, improve it, make the value go up. And I mean, these things still trade on a net operating income cap rate
Yeah,
kind
yeah.
of market. What I'm just kind of curious. I think probably the majority of the people I speak with are some attached to multifamily. What kind of cap rates are you seeing in this market?
Yeah, you're depending on the market that you're in, if you're just selling one property, um, they're roughly give or take 6 to 7% cap rates, maybe If you're in maybe like the Midwest or some of those markets, it might be a little bit higher. If you're in California or Southern California, depending on the tenant's credit on their lease, you can maybe get a little inside of a six. So cap rates, they're they're trading for the iOS product. They're trading a little bit higher than your standard Class A, Class B industrial product.
Yeah. Well, cash flow, I mean, that's typically, at least what I find is the cash flow usually is a little bit better as opposed to just the appreciation game. Um, but if you're able to get in and improve it, and increase the net operating income, you're going to get your multiple on the exit. Um,
hmm It's all
seems
it's
like
all
a
about it's all about the location and the tenant that you can get on the lease. If you get a good tenant on the lease, some of these trade like they're, triple net lease, uh, just single tenant net lease properties, like almost like retail
yeah,
properties. So there's a big sector of the net lease kind of game there's tenants that are industrial tenants in that sector. And so a lot of those overlap with the stuff that we're buying. And so we'll try to lease it to those tenants, and then you can sell it to like a 1031 exchange buyer or a private investor instead of selling it to another investment company like us.
yeah. No, that's interesting. The potential buyers. I've seen not these specifically, but I mean occasionally I see um, similar type properties and like you mentioned, 1031 exchange opportunities. But that's fascinating. It's funny. I know what the properties look like, and it makes complete sense. The demand, especially if there's a lot of activity or industry or there's. I mean, you think about just the cost to drive vehicles a long way, especially big vehicles that consume a lot of fuel. To have something that's nearby to store it, as opposed to going back to a home base or something like that. Especially if you're going to be working in the area for a long time, makes a lot of sense to have something
hmm
locked up. Um, well, it's kind of interesting. It's funny, the all of the different asset classes in commercial real estate. I think this is the first time I know this is the first time I've talked to anybody about just the outdoor storage. Self storage has been kind of um, a buzz last couple of years. I think most markets have seen a lot of build out on that, but this larger industrial, kind of the cell or the outdoor storage, um, it's it's the first time I've talked with anybody, so I'm glad we had the chance to talk.
Yeah. Yeah.
So,
I definitely didn't think I'd be buying junkyards when I got into the real estate business. I used to be a corporate real estate broker at JLL. So it was like, I was representing like really big companies, and we were doing like Class A development deals and like really big corporate deals. And I ended up like falling into this space, and I repped a couple companies that needed to find properties like this, and they just couldn't find anything. And I was like, wow, there's no one specializing in this, and the tenants have a hard time finding it, and they have to have it for their business. They need the zoning, or they can't operate in that market. There's just not, they can't go anywhere. And so I saw that that was happening, and then right at that same time, there was a bunch of groups like us that started coming into the space and buying up some of these properties. And I got lucky and started representing some of those guys too. And then instead of doing the big sexy development deals that most of the guys were doing at our company, I started going door to door and walking up to these yard properties and throwing on boots and going to talk to those guys, and it ended up working out.
yeah, no, it makes complete sense. I mean, it's it's always the big identifiable uh, shiny new building. Everybody knows what that is. But the risk with that building is huge. You've got tons of risk. I mean, the capital it takes to get the thing done. And then you've got things like COVID. If you've got office buildings, all of a sudden we decided we work from home, or retail is going online, or whatever the case may be. But this is basically just kind of your bread and butter, there's a need for this all day, every day in a market where there's commerce, um,
Hmm.
you know. So I love I love the idea of it, and again, it's like you were saying, it's um, you know, not anything you would think of right away, but I'm guessing the numbers. I mean, the demand is there. There's a market. Uh, there's an opportunity, and
Hmm.
that's kind of cool. I love hearing the stories about people that find the opportunity, in whatever the market is. Um, and I think that's one of the my big attractions to real estate. Period is just that I've got clients that they figure out how to make money in any market.
Hmm.
It's not, oh my God, it's a horrible market. I mean, they find the opportunity, and
Yeah.
they're always doing well. So cool. Hey, Blake, if we could, I'd like to shift gears here for a second. As I
Yeah.
mentioned to you before we started, by day I'm an insurance broker, and asked that to work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, the local municipality rules or codes or interest rates,
Hmm.
whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Blake Rodgers, what is the biggest risk?
Sure. So I think in our space, we say this all the time to our investors because they ask us this question as well. What do you think the biggest risk is here, guys, with this asset class? For us, it's really since we're buying single tenant deals, I think it's the single tenant nature of these deals. We're buying vacant sites a lot of the time. So the risk for us is you either lease it or you don't. And you either do it in the amount of time that you said you would or you don't. So that I think that for us is just being hyper focused on, how long is it going to take us to do this? What are all the other, properties in this market leasing for, making sure we have all the data and that we're underwriting the amount of time that we need to lease these up and that we're buying a product that these tenants want and that's not going to sit there for a long time. Because that's the way that we can really get hurt. But we can control this risk though. This isn't, just like a macro risk. A lot of guys in our space got hurt pretty bad 4 or 5 years ago when interest rates went crazy during COVID. And so that was a huge risk. And some of those guys just didn't foresee that coming. And so that's one thing. But for what we can control in buying these types of properties, it's really determining how long do we have to lease this and making sure that we execute on that business plan.
Yeah, there's nothing more frustrating than an empty property uh, and no prospects kind of thing. So I would think that is a well said, and especially if you're looking for a single large use tenant. But I'm guessing you guys are pretty tuned to what the market is and the demand before you go in and make a purchase. But I appreciate you sharing that.
Yeah.
Hey, Blake, where can the listeners go if they would like to learn more or connect with you?
You can go to our website, steelpeakproperties.com, or you can connect with me on LinkedIn. I'm happy to chat with folks on LinkedIn and connect. And yeah, glad to be on here. Thanks for having me.
Awesome. Well, Blake Rodgers, I can't say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Awesome. Thanks, Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.